What I realized over the years is how much noise there is in this business on the retail side. People are bombarded with cool sounding terminology and stressful things that do not help you in any way. I mean, everything from tick charts, news flashes, the spreads, the pips, the schmips, whatever the terminology of the day is just thrown in your face like a stress factor. Like you got to do something because some terminology, something, constant updates. And yeah, if you do this as a hobby and you think this is a fun thing and you enjoy doing it, then fine. For the vast majority, none of this will help you. It's just noise. So we are trying to turn off that noise. Therefore, the name Hush is going to be very quiet, very calm type of app.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Rich, we are very lucky to be joined by Andreas Clenow today. We've been looking forward to this show. G'day, Andreas. How are you going?
Hi, good morning. Yeah, doing all well. Thanks.
Hi, Andreas. Great to have you on board.
Good to see you.
Thanks for getting up early for us. And beautiful summer's morning in Zurich, you were saying. You cycled in.
It's excellent over here, yeah. Nice and warm. A little bit too hot, but, you got to complain about something.
Yeah. Beautiful part of the world. I do like Switzerland. Look, we'll jump straight into it, and as we always do. And I guess I'll start by introducing you a little and just saying that obviously you're someone who needs little of an introduction. I think a lot of our listeners will know you or have read your books. Obviously, you've been in the industry for quite some time, and for those who don't know Andreas, I suggest perhaps starting with his websites, then of course his books, and he has had many other podcast appearances, so you can get a feel for his history on those. We won't go into his lengthy background on him, but suffice to say he's had a long career in systematic trading, funds management, programming, starting in computers, which is a major advantage given the systematic and quantitative path that he's taken. He's also quite an entrepreneur, has a very commercial view of trading, which I find is very interesting. We can talk a bit about that. I've always loved listening to his very real and honest takes on trading, and certainly I remember hearing him talk about setting expectations and just bringing the expectations down a bit, I think, from when we first start and think we're going to shoot the lights out. And that's always good to hear. You need to hear that from the professionals, and especially from Andreas with his dry sense of humour. It's always a good listen. And he's written 3 great titles in the trading field, 3 textbooks, if you like. So the first on following the trend, there it is, Rich, the futures trend following manual, and then of course he had to say something about stocks on the move, momentum trend following in stocks, and his latest edition is it Trading Evolved, Andreas?
It is, yes. It's let me see. I got a copy here.
There we go.
That one where I go into a little bit more detail on the practical side on how to actually how to set up your own backtesting quant environment locally and learn a little bit of Python and get it done yourself and verifying it, and not just trusting people like me, but rather just how you do it and how you verify it yourself.
Really keen to chat a little bit about that as well, actually, and then we'll mention the other book in a moment. There is one more that's just come out, but obviously now you're working at a Swiss family office. You've been there for many years, now a partner there, and being an entrepreneur, your latest entrepreneurial endeavor is also something that I'm keen to chat about. That's something that's very interesting. So hang out for that. So to sum up, continuing our theme, I guess, of the last couple of guests we've had on the show where we've talked about both futures and equities, Andreas is a great next guest because he also has that experience in both those worlds. So I'm looking forward to continuing that chat, the wisdom that is gained by having had a foot in both those camps, what we can learn from them. And of course about trend following, but as much about any other kinds of ways to generate alpha out of the markets, then for sure I'm keen to hear about that as well. So I think for the theme of the show, Andreas, if we could, talk about the models that you would employ if you were trading today in those, how perhaps things might have moved on from the publishing of the books, or just given your experience over many, many years. What are some of the standout sort of principles and lessons in model development, in avoiding overfitting, these kinds of principles, both in the equities and the futures world? Perhaps Rich can start off by talking to you about the futures and the trend following, and then I might follow up by talking about equities. So the fourth book, let's just go left field and start there. You've written a novel, mate, and what happened there? What inspired you to go down that path? Tell us about that.
Well, I mean, for one thing, I wanted to see if I could do it. I'm a non-native speaker. I'm very interested in English language literature in general. I wanted to write a novel for a long time, but I didn't know what to write about. And I figured I got a lot of stories over the years. I work in a very absurd part of the business in a very special town. Things happen in this business in this town, and a lot of things happen that you can't really say outright for all kinds of health reasons and otherwise. So I figured I can tell a lot of things. I can teach a lot about how things actually work, and I can do it in my way, in a way that fits me and my weird sense of humor, and I can fictionalize it. So I fictionalized it where some parts are real, more real than I think a lot of people would be surprised over how much in the book is actually real. Clearly, I have condensed people and events and time frames. The entire book takes place over a course of 1 week, 7 days in the city of Zurich. So clearly, everything is a lot condensed. Not everything is real, but I will not tell you what is real and what is not. But in my view, you can learn a lot more about actual high finance from a book like that. I think a lot of people might read it and still not believe me on that, but it probably teaches you more than reading a book about, backtesting futures models. So that's what I wanted to do.
It sounds like it already sounds like a movie with Jason Bourne.
It's got that vibe to it. It's sort of got the it's got the sort of the covert cover, which looks a bit sort of Humphrey Bogart type style,
Yep, which is exactly what I'm going for.
Seedy undercover stuff happening in Switzerland.
You're actually spot on, because I'm a big fan of a genre of novels, but which was popularized in like the 1930s, I believe. It kind of started with Dashiell Hammett. What was the guy who kind of launched the genre of hard-boiled?
Yeah.
Close to noir genre. Most people are more familiar with noir. It's kind of close, but hard-boiled is a category by itself, and that's what I'm going for. So yes, and I also realized that the cover artists seem to think I should hire Matthew McConaughey. So if you're listening to this, then Matthew, give me a call. I'll make it happen.
I can see there's a couple of nice dames in there.
The femme fatale, of course, yes.
Yeah.
Excellent. Look forward to reading it, Andreas. A very private bank. That's what it's called, correct?
A most private bank.
A most private bank. Okay, good. All right. Well, Rich, do you want to kick off chatting to Andreas about his his first book and what you got out of it, and let's dig into some of the models and what Andreas's principal lessons of building futures models, trend following models are.
Will do, Simon. So, just to give you a bit of I'm not blowing smoke here, Andreas, but your book I would regard as the best book I've read on
Thank you.
investment and finance. That goes back many years to when you released this book, which was following the trend. This one here.
Yep.
Now, a lot of people in our trading circles cite reminiscences of a stock operator or Jack Schwager's books as the key books to read. But I would say they're good for sort of a narrative about the successful people in the field. But Andreas's book is fantastic if you want to actually learn the mechanics of diversified systematic trend following. So that book to me was a standout, an absolute standout. And it's a pleasure. So, look, in the book, to give you an idea, there's an introductory prelude to it, and then Andreas comes in with a couple of very simple systems, but highly effective systems, which are deployed in the futures markets under fairly heavy diversification across asset classes. And the results are very good, very good. And then the book sort of goes into the psychology of experiencing the performance returns of trend following over many, many years. And each year, you sort of and Andreas forces you to have to read each year in detail because you sense the volatility that you're experiencing as you go through. So even though when you first see that track record, you say, I want that, and it looks like a fairly smooth ride, the experience that Andreas describes is certainly far from that, and it's quite a psychological trauma to get through those sections, but it's fantastic. But in the original book, which I've actually got his latest updated edition as well, which I think was done 2023. But what I have noticed is your dropping of the section of replicating the performance of the different CTAs. Like if in your first book, it was stunning to me because this is the first time I realized that Andreas had this amazing skill at being able to sculpt equity curves to his liking, and basically using these simple systems, his choice of universe basically dictated the outcome. And so he was replicating a trans trend, Gunn, Mulvaney, all of these different CTAs that we know and love about, just by changing the specific universe in the asset class mix. And I noticed that wasn't in this latest update. And I'm wondering, given now that we've got lots of replicators in the business, DBMF and all of these different replicators, I'm wondering whether you got a bit of flack from industry in being able to so easily sculpt their performance returns.
No, actually not. I was worried about that. To be honest, I was very worried about that. That was one reason why I made sure my first book was published under UK law and not US law, because there was one fund in particular. I'm not going to tell you which one. I was a little bit concerned that they might have, they might not appreciate some of the things I was writing in there. I was trying to be very diplomatic, but in my view, in my assessment at the time, it very much looked like they dropped the ball a bit. They changed their strategy at one point because I could correlate the trend following to a point, and suddenly it stopped correlating at the worst possible time, and then it starts again. And it looked very much to me like it looked very much to me like they made a big mistake here, and I need to be a little bit careful here because I'm still kind of calling out the multi-billion-dollar corporation.
Yeah.
Much to my surprise, I took a lot of steps to make sure I wasn't at least legally vulnerable on it.
Yeah.
And much to my surprise, I think about a month after the book came out, the CEO of that company called me up and said that you're absolutely correct. That's exactly what happened. I'm coming over to Zurich. Let's go for a drink and I'll tell you all about it. So no problem.
Yeah.
Then again, I think most people understand the concept of, he's a super nice guy, don't get me wrong. Most people understand the concept of being careful picking fights with people who buy ink by the barrel. If you're familiar with the expression. Once the book takes off, that's a bad time to pick a fight. It's going to look bad. But anyway, they were very good sports about it. No, I think the reason I found it less interesting, I can't actually remember the decision to remove it, if I removed it or the editors removed it in the end. But when I first wrote the book, and this was like book came out in 2012, so a year or so before that I spent writing the book. There were a lot more pure funds. The industry changed a lot for all kinds of reasons, better and worse. But there's still some kind of pure trend following shop, but most have just mutated in a way that they combine all kinds of different things, and multi-strategy things.
Multi-strat. Yep.
Yes. And that makes it a lot less interesting to try to correlate them to a single model. I would need to see their individual submodels. And of course, yes, they will show it to me under NDA, but I can't write about that. So it gets less interesting from that point of view.
Yeah. It's certainly been discussed in industry in that there has been this evolution post 2000 towards multi-strat from a lot of the big funds. And I can see why that's happened, but there have been a few small core representatives who stayed firm to the classic trend following tradition, Jerry Parker, etc. And I can see why they're doing that, so that they're offering this sort of trend, this classic trend form, as opposed to some variations of that, inclusion of different strategies or whatever. But it's interesting. We've seen a significant resurgence in classic trend from 2020 on, and of course you'd know about Mulvaney's performance. We would regard him as classic trend. He hasn't changed his models for decade or so. So I'm just surprised the resilience of classic trend and how it can really push out the big numbers in the appropriate environment.
Yep, true. But you also keep in mind, I mean, I know this is the theme I keep coming back to, but you always have to look at the two sides here, right? I mean, nobody is. I'm careful mentioning individual shops here for all kinds of reasons. We are in a highly regulated space, but let's say you run a pure trend following, really pure trend following, and I have all respect in the world for that. You might also see a lot more drawdowns, volatility. You might have much more problems raising big money from institutions. That's a different thing, of course. If you're trading for yourself, it's a whole different game than, say, you're trading, I don't know, reasonable low amounts, say in the tens or even hundreds of millions of kind of high net worth money. Or if you're running a multi-billion-dollar fund and you're going after the big tickets from pension funds, institutions, and you're negotiating $50 million tickets perhaps. Now you're talking to a whole different audience, and whether or not you can deliver long-term high positive return numbers is not the big factor here. It's volatility control, and the game changes completely. That's the main reason why they change. It's not that there's a big problem where you can no longer make money in trend following. That's ridiculous. But the problem is you're running a business, and you need to look at more factors than just what's the average annual return over 10 years. Much more complicated than that.
Well, I'll bring it to Simon's question, which you wanted to ask. If it was trading your own money, would you stick to the classic trend following style as opposed to these multi-strat blends?
No, I think from a logic perspective, look at it this way. All the stuff that I normally write about, they're building block type of strategies. As such, they are not bad. It's the same thing with most hedge funds. In a hedge fund world, if you start a hedge fund, you're effectively running a building block, not a complete solution. Now, how do you want to allocate your money? I mean, very few people anyway, would say that it's a good idea to put all your money in one strategy. I mean, that goes against the entire portfolio thinking that, I mean, one of the few really good things coming out of modern portfolio theory. You can say a lot of things about modern portfolio theory, but diversification is a very valid concept. So how would you manage your own money? Well, you wouldn't put it on one single thing, would you? I mean, you might think NVIDIA is a great stock. Would you put all your money in it? Or whatever stock you're looking at. It's not how you do things. The same thing with the trend following. Trend following is a great building block. It's not an entire portfolio.
Okay, so the 2023 edition, I noticed that you've updated your models, which is fantastic. There's been a bit of a change in some of the models you're using there, and I'm yet to. I'm certainly going to put it through the crucible in the environment and see how they go. But still, simple, robust models applied across diverse asset class grouping.
Mm-hmm. So let me tell you why I changed the rules. You probably noticed I made the rules even simpler, very much on purpose. You see, the point of my first book, actually, it's the point of most of the stuff I'm writing about. I never tried to say that, look, this is a super great model. You should all put your money in this thing. I'm trying to explain a phenomenon. I'm trying to teach something here. I'm not saying this is the model you should go out and trade, because it's not. It's an educational model meant for you to learn from. Take what you like, make it your own, understand what it is. Never take anybody's model and trade it. You should never ever do that. Doesn't matter who built it. You don't trade somebody else's model without understanding what it is and what it does. And so in my first book, I just tried to explain to people what trend following really is. Because I've been working in that field for a while. I built a bunch of models. I traded them. I read some books, and I guess I was probably unlucky. I picked up the bad books, and I realized that these books don't seem to understand how this is actually done. What they're writing about does not reflect the reality that I see in the business. So I figured I'll write a book where I explain how it works. You need to simplify a little bit, of course, because the proverbial devil is always in the details. But I wanted to explain where the big returns come from and why and how. That's what I'm trying to do. And then I realized with the first book that some people misunderstood the book, even though I tried to get that point across. Some people misunderstood and thought this is like my suggestion of the Clenow supermodel that you should put all your money in, and that's not my point. So therefore, I wanted to simplify a little bit further to show that I'm just explaining to you how this concept works, how you go about building these things, where the returns come from, and what's important and what's not.
The unfortunate thing is, Andreas, is as you simplify, your models are getting better, and I have a gut feeling that might actually be foundational to the need to have simple, robust models with trend following. So, but you're very explicit in your books that these were simple models, not necessarily models deployed by industry. Industry perhaps had more bells and whistles. You're always very explicit about that. So, and it was always very much an educational guide. But very, very good book, Andreas, and congratulations on that. But
thank you.
I'll move now back to Simon, where your next big epic was your stocks on the move. So over to you, Simon.
All right. Well, not that I think I'll probably come back to futures at some point, but let's keep the momentum then. So okay. So stocks in the move, Andreas. I've been primarily a stock trader, apart from when I dabbled in trading single futures contracts on an intraday basis years ago. Obviously it's very different. So I just wanted you to maybe rehash a little bit from the book, but also just your up-to-date thinking, if you could guide people through some of those key differences between trading futures, trading stocks. Of course, I'm thinking of leverage, and I'm thinking of the correlation of stocks when you need it least. The beta that you are largely trading with stocks. And so what that means, and some of the ways to tackle that, and how you would go about tackling that to build a model on stocks. And then if that's a trend following / momentum model, and if there are other models that you think are worthy. I know you're a guy who doesn't necessarily like having a label, which is a bit like myself. Like, I'm happy to go where the research leads, where the returns lead.
But one thing, Andreas does like throwing grenades into the bunker, because I remember when Stocks on the Move was about to be released on his website, he said, here's a grenade I'm going to throw in. Trend following doesn't work on stocks. Boom!
Yes.
Yep.
Came out on his website, and I thought, oh, that was cheeky. And I think it was deliberately cheeky, but Andreas, please explain.
It was, yes. It's a long story, but yes, somebody claimed that I had said that trend following doesn't work on stocks, and I couldn't remember even saying that, but I don't know. Somebody somewhere said that this guy says trend following doesn't work on stocks, and I couldn't remember saying that, but I say a lot of things, so it's possible. So I figured, why not? I write a book about why trend following doesn't work on stocks and why momentum does. And I'm splitting hairs here. I'm splitting hairs on purpose. You can say it's very similar. Why make such a big deal about the difference? There is a point, apart from the grenade throwing, which is always fun. The big point is I wanted to make sure people understand the difference. Because if you take a standard trend following model the way we do it on futures and apply it on stocks, you're going to crash and burn. That's a very bad idea. They're not the same. The reason for that is, two things here. As Simon just said, there's two main differences, a lot of small ones. But first, in the futures world, we have a lot of assets that do very different things. We have commodities, we have stocks, we have bonds, we have money market, we have currency futures, we have all kinds of things. They don't necessarily have very high correlation. Some of them have negative correlation or very low correlation. That means we have all kinds of diversification possibilities that just do not exist in stock world, where everything moves up and down at the same time. Some stocks are better than others, but in the bull market they all pretty much move up. In the bear market they all turn. So we have a whole different possibility there. The other thing is, of course, the leverage. So in stocks, leverage is very expensive and dangerous for all kinds of reasons. So there's a clear limit to how much exposure we can take on in the equity world. On the future side, on the other hand, we can do whatever we like. We're limited by risk considerations, not by exposure. So that's in the future space, you can sometimes take 1 to 100 leverage, even more, depending on what you're trading. That sounds crazy, of course, but we're talking about super low volatility things like, Fed rate or something that doesn't move much in terms of percent. They're just different. I just want to use different terminology to show how different they are.
Of course, with stocks also, Andreas, there's just so many to choose from, even if they are more correlated. There's a lot more which necessitates usually some kind of selection/ranking criteria, right? So do you want to talk a bit about whether, what your approach has been to applying these kind of momentum models to the stock universe?
My first consideration when designing a model is really what kind of outcome I'm looking for. And I'm returning again, like a broken record, to the whole business side. You never really say, I want to build the best possible model with the highest possible return. That's a little bit on the naive side. You're looking for a product of some sort. You need to fill a gap in what you have at the moment. You need to have something that has a certain return profile or correlation towards something else you're doing. Or maybe you have clients who need some sort of solution, so you're designing something for a purpose. That's the first thing. Say if you start out just doing your own money, maybe you're thinking, should I do, intraday trading or weekly or monthly? Well, that's not where you start out in the business, because you already know more or less what you want to do. Now you just want to make the best out of the constraints you have at the moment. So how would you approach it? Well, first you need a good backtester. You need to understand how backtesting works. In my view, it is absolutely necessary to understand programming to do these things. The good news is that you don't need to be an expert in programming. You need to understand enough. You also need to have some understanding of statistics and numerical analysis. And you need to be cynical enough not to trust any sort of backtesting software. Whatever comes out there, you do your own math. This is all of this software calculates things differently, and don't run out of the box stuff. Those are the basics, of course. Then you need to consider all the variables. How do you handle selection bias, for instance? What stocks would be reasonable to trade 10 years ago? It's certainly not the current set of S&P 500 stocks, right? Those stocks are in that index because they did well and got included. 10 years ago, the index was different. So you need to take that into account dynamically. You need to take dividends into account. That's something that's way too often missed because it's difficult. So most people run their models on price data, and that means, of course, when dividends is paid, well, that stock is going to gap down, right? Which is not reality. There are all kinds of small things that common mistakes people do when they start out. Of course, if you've been doing this for a while, you should understand these things. And then, of course, the usual. You don't take one model and run it 50 times in the same data with different parameters until you get it right, because it doesn't say anything about predictive value. It just said that you just managed to curve fit something to the recent past. All kind of basic things if you when you start modeling. But understandable mistakes to do, especially the last one where you just test a little bit. Hey, a 10-day moving average didn't work. What if I use 11 days? Hey, now I get results.
Yeah, absolutely.
Yeah,
Sure.
Right. So I want
once
to
again. Yeah.
delve into that a little bit, but I'll just give a shout out to, speaking of data and having dividends and adjustments for which stocks were in indexes at which time. I mean, these things are so critical and so important. So, the listeners should jump on our website and check our tools page where we talk about Norgate Data. We talk about, a backtesting platform that integrates that with that is just such a simple way to get started. If someone wants help coding up your strategies in that software, I'm happy to get an email about it.
That's real test.
As long as
Simon.
they've as long as they've got your book, Andreas, we'll
Yep.
we'll
Sounds
work
good
with
to me.
them. Yeah,
Sounds good.
so we can we've got real test on there that we use as well as SQX. So some out of the box platforms that are good to get people started, and then of course your new book is talking about using Python and building your own stuff so that you can really validate. So I'm super keen to chat about that a bit later. But just coming back to stocks then. So in your Stocks on the Move book, well, firstly, you come up with a methodology for establishing momentum. So it's a little bit different to looking for a breakout, say, in a trend following system in commodities. We want to establish,
Is
which
this with the
stocks look-
famous Clenow indicator that you've given your name to?
That started as a joke, yes, but it kind of stuck after a while. It was meant as a sarcastic way of, I don't know. I was trying to poke fun out of how everybody wants to name an indicator of themselves, and then it kind of stuck.
Unlike Andreas to poke fun at anything or
Absolutely.
anyone. No, yeah, of course not. But Andreas, so we're looking at establishing momentum in a stock, right? And then ultimately using some kind of rotational mechanism to stay in the stocks that are exhibiting the most momentum. Can you just talk a bit about how you came up with using a linear regression model, basically, to look at regression, to look at momentum in stocks?
I wanted something to fit. I wanted the whole thing to fit together. So I needed two different things, right? I need to measure the momentum and the volatility of that measurement, or the error factor of that measurement itself. I could do, I don't know, something simple with just measuring the price difference between 2 points, rate of change. I think most platforms just call that. And maybe I add, I don't know, divide by ATR or something and see what happens. But much of these things are just based on, like a lot of technical analysis stuff, is based on the lack of computing power. If you look at a lot of calculations from technical analysis type of indicators that are still in use today, they're developed on purpose by people who were using pen and paper back in the days. I mean, the math was simplified to be kind of good enough, but equations can be solved with a pen and paper. Why are we still using them? Because some famous guy in the 70s came up with it and he did well back then? Yeah, sure. But I mean, if he had access to the computing power we had, he would have done it differently. So why are we copying it? It's not like, I don't know, those guys somehow hated computers. They just didn't have them. So I wanted something that does a similar job. I want the math to be nicer, to be cleaner, to fit together. And this method seemed to work fine. So what I do for reference here is, first I calculate an exponential regression rather than linear. Linear regression of stock prices would tell you, as a slope, it would tell you how many dollars, currency units, something moves up and down per time unit per day. If you do an exponential regression, it will give you that number in percent instead, assuming here that percentages are something we care more about than the price in dollars of the stock.
Sure.
Then, of course, that means that if I just use that, and say we have a stock that just went sideways for a month and then suddenly it doubled, that would show pretty strong exponential regression. But of course, the fit on that line, if you understand, if you remember your statistics class from back in school, the fitness of that line will be very poor.
Yeah.
So I used a very related measurement. I used the R square, the coefficient of determination. I'm not gonna bore everybody to death with the mathematics here, but basically it just tells you how well does the data fit to the line we just calculated. So I multiply the slope by the R square, the coefficient of determination, because that number will give you, it will always be in the range between 0 and 1. So
that's looking at momentum quality, effectively, their coefficient of determination,
Yep.
etc. Okay.
Yep, exactly. It's the quality of the trend. So if each data point was exactly on this upward kind of sloping exponential line, exactly on that line, we will get a fitness or R square of 1. If it's lower, we get a lower R square, closer to, well, it's going to go all the way down to 0 if there's no fit whatsoever.
Yep.
So it's a very useful thing. I just multiply the two, and now I kind of punish the stocks that have very low fitness of trend, very low quality of the trend.
Okay, so now we've got a factor to rank all of the different universe of stocks on. Is there a particular universe that you find more productive? Is it the mega caps, or is it the smaller caps that might trend more?
I don't have a preference. Again, it depends on what kind of thing you want to design. For me, that's a business decision. What do you want to accomplish? They could have different properties, or you could have different clients looking for different things, or maybe you have one and you need the other one. But to say that one is better than the other is very dangerous. There are periods in time where small caps are massively outperforming, and there are periods in time where the blue chips are outperforming. So I don't see a best. It's a business decision. What you would
Look,
like
I
to
do really
on.
appreciate how you always do bring it back to this commercial decision and commercial decisions that get made in trading, Andreas. I think it's really relevant, because as you say, if you're a personal trader, you've got a certain objective. If you're working for a firm, there are other constraints and other objectives. You might just be trying to fill a particular hole with a particular building block. You can't be all things to all people.
Yep.
And it really is important for any trader to be really getting a grip of just how much it is a business decision in every step, in everything that they're doing. It's commercial, and it's that commercial thinking that helps you design good strategy too, I think.
The first step of portfolio management is understand your client, and in the case of doing it yourself, you've got to understand yourself and your objectives. So really, step one.
Sure. Let me give you a stupid example. Let's say you built a classic trend model, and it does really, really well. And you think the best thing you can do, your biggest skill here is this medium-term trend model. But then you see that there's a lot of competition in this space. I mean, you can't swing a cat without hitting 5 people doing that. And maybe they have a lot more, they manage a lot more money than you do. They have a bigger budgeting for budget for marketing. They already sold to the guys that you could possibly sell to. They already manage money from the companies or the people that you know that you want to sell to. You want to enter that crowded space? I mean, maybe you're slightly better, but you're fighting an uphill battle here. Then maybe you realize I need to modify it a little bit because they already have this medium-term trend following on everything. Maybe I can do something better. Maybe I can move to a different time frame. I move to a different asset class. I do something different with it because then I can actually raise money and build my business without going head-to-head with everybody else who happen to be in this sphere. I mean, trend following here is just one example. It could be whatever your situation is. Something is crowded and something is not. Find out where you fit in the ecosystem and find your niche.
No, it's an excellent point. All right, so just pushing on a little bit more with the equities model. Tell me about the rebalancing process then. So there's many more stocks than futures. We're constrained with how many we can buy. Now, I know you've got a sort of a risk parity.
Before the rebalance, how many stocks are you dealing with, Andreas? Typically, I suppose it's dependent on your level of capital, but is there a certain number, because they're unleveraged, are you dealing with 10 stocks, 20? Is there a sort of some guideline there?
Well, I know. I always come back to it depends. But you would want to have enough stocks to get some real diversification benefits. I think 10 stocks is gutsy. I mean, 10 stocks, you can get some very interesting returns, but you will also get some very interesting volatility with that, if that's what you're looking for. I would prefer to go a little bit further. I mean, I built trend following models that trade all the stocks in the S&P 500. It just, I mean, as in holding all of them, it just weights them differently. I built those kind of things, and I've had models where you have 20, 25 stocks. So the more stocks you have, obviously, the closer you will get to some sort of bench, because we're talking with momentum here, at least the way I talk about it. We really have a long-only model, which is, let me see, the old book, it's been 10 years since I wrote that book. In that book, I had a trend filter, so it scales out of the market, but it most of the time it's like 100% invested. I also had models that are always 100% invested. They just shift the weight a little bit. How many stocks you have? You should consider quite a lot of stocks, as in your investable universe, because you want to have equities is a target-rich environment. Why limit number of stocks that you're considering? I would say for a normal use, you probably want to have at least 25, 30 stocks in a portfolio. More than that, the benefits of diversification start slowly going down. You might benefit from a little bit more, but stocks are stocks, so they're going to behave quite differently. If you have 30 stocks or 50 stocks, you get more or less the same benefits from diversification.
Okay. So you do a risk-based position sizing, and then you rebalance. So talk to us about this rebalancing process and how you're going to stay in the stocks that have the most momentum, and what some of the rules are around that.
So when you have, like, I wouldn't say allocation type of models, but more investing type of models, which this is, rather than a short-term trading type of model. That means you might hold positions for a long period of time. Maybe you hold the same stock for a year or 2 years or 3 years if it goes well. You can't have the same weight all the time, because then you end up at a random risk level. You always want to have deliberate risk. Like, it's not a matter of taking little or much risk, but you need to understand how much risk you have, and you need to do it deliberately. So if I just buy, I don't know, a 5% position of a company, and I hold it for a year or two, I no longer have a 5% position, right? My position size will depend on the performance of the stock and the performance of the rest of my portfolio. So if I want to make sure that I have a certain risk, I need to maintain that risk. Also, keep in mind here that risk is different from your exposure. So what if the volatility of my stock changes? Well, I also have to adapt the size of the stock. So if I have a target risk allocation, that's going to change on a minute-to-minute basis. So what I would need normally is like, first establish a no trade zone. I don't think I went into that level on that book, but basically a range where I don't care. Like, position should be between here and here. Inside, I don't care. You can bounce around in there. Then I need a rule for when to change it and how to change it, how to reset it. That's called the rebalancing, to reset the weights to where they should be. Normally, you do that quite often. How often depends on a few factors, like your trading cost, obviously. It depends on your tax situation. For you poor guys out there who pay capital gains tax, welcome to Switzerland if you don't like capital gains tax. Yep. That's it's a benefit with the nice alpine climate over here. No capital gains tax. Anyway, you need to take some of these things into account.
Still
obviously,
can't
if
afford to live there. Still can't afford to live there, though. Couldn't afford to buy a beer.
It's a special place. That's for sure. Sorry, I lost my train of thought.
So you're talking about your volatility adjusting, and how that your frequency of rebalancing is dictated by a number of considerations. It might be the how volatile they are, etc., or it might be objectives. You're going through those.
Yeah, exactly. Oh, yes. I was going to say as well that's where I left it off on your considerations for when and how to rebalance. Let's say you're managing a pool of money for other people, like a fund. Then you have very different considerations as well, because, well, first, you don't trigger, no matter where you are in the world, you don't trigger capital gains taxes if you rebalance, right? It's inside the vehicle. If you have a US-based fund or an EU-based fund, I'm sure Australia as well, Capital gains taxes will be triggered for the investor when he exits your fund. What happens inside the fund doesn't impact. So then, of course, you don't have a consideration. But if you're managing a mandate directly for an individual, you're triggering capital gains tax if you trade too often. So something you just got to optimize as well.
Bring this all together and just to continue to learn from your approach to equities and futures. Also want to ask about ETFs now, but let's jump into your latest endeavor, which I'm super interested in any entrepreneurial activities, especially if they are revolving around trading and doing something new and novel in the space. That's exciting. So tell us about this new venture, and then I want to pick apart how you're trading in there.
Right. So I'm a co-founder of a US-based venture that we are launching an app that we call Hush, Hush. Obvious question, why Hush? Well, what I realized over the years is how much noise there is in this business on the retail side. People are bombarded with cool sounding terminology and stressful things that do not help you in any way. I mean, everything from tick charts, news flashes, the spreads, the pips, the schmips, whatever the terminology of the day is just thrown in your face like a stress factor. Like you got to do something because some terminology, something, constant updates. And yeah, if you do this as a hobby and you think this is a fun thing and you enjoy doing it, then fine. For the vast majority, none of this will help you. It's just noise. So we are trying to turn off that noise. Therefore, the name Hush is going to be very quiet, very calm type of app. We want to manage money and help the vast majority of people out there, is particularly young people, to start early, to save money, to invest money, and to get healthy financial habits. You sign up to this thing. Don't worry, I'm not going to pitch the app too much here, but you sign up to this thing. You set how much money you would like to invest at the moment and how much you want to put in on a weekly basis. We want to build a healthy habit or put aside something every single week. And trust me, it makes an enormous difference. We have no economic incentives to make you put money every week. We want to help people to get the habit. $1, $50, whatever you can afford a week, put it in here. We'll manage it for you. So that's in a nutshell what we are doing. We're trying to offer, say, institutional grade asset management nearly for free, even for free. For small accounts, we're completely free. And we charge maximum $5, never more than $5 per month management fee. That's it.
Andreas, let's say I'm starting off small. I'm 10 years old. Dad's just given me $10. I put that into the app. Are you investing that immediately? You're pooling it and then investing it immediately, or does it have to build to a sufficient balance before it's invested?
Nope. We are investing immediately. We are not pooling it. We're managing individual accounts with no lower limits. So yeah, you can put in your $10 and we'll manage your $10 for you in your individual account.
Amazing.
Now, clearly this is based on scalability. We have tens of thousands of people that we're managing this for. It's mathematical, of course. I know you're going to ask me how in the world could I possibly build systematic models on $10? I'll happy to answer. But yes,
Please
that's the obvious question.
Indeed, tell us.
Right. So what we are doing is, let me tell you the mechanics first rather than the strategy. But I'm happy to go into the strategy as well. But we are trading fractional shares, so we can build highly diversified, systematic allocation portfolios. For tiny portfolios. We can buy 0.0001 share of a company.
Ooh.
That is the main trick. Therefore, we can build very rational, long-term dynamic portfolios on tiny accounts.
Very cool.
I'd love to say how you're doing it, but I know I'm getting into secret sauce area. But
No. We intend to be super transparent. I mean, I built my career as an author on the whole idea of being the most transparent guy around. I give you the rules. I even wrote a book where I gave you all the source code, right? So, I always said in public that somebody keeps too much secrets. You shouldn't trust the person. If all these models and everything is black box and proprietary, then you have to wonder if you should trust it, because as an asset manager, you don't really lose much by giving away those things. You still have to do it, right? I can tell you exactly how we manage money on the hedge fund side, but it doesn't mean you can just press a button and do it, right?
Yeah.
You're paying us because we got the infrastructure, we have the people, the staff, the compliance, we have the admin, the auditors. We're doing it for you. You want to do it yourself? There's a lot of work, but feel free to do it.
You've gone to a new level. There's an app over here called Roundup, which is it effectively set up for the superannuation fund industry in Australia here. But the options are limited. You say, okay, I want to be a growth investment, I want to be whatever, and then you get these broad parameters you put in there. It takes your spare change or whatever, and this roundup function occurs. But you're going to a whole new level now where you're so. Can you go into the details of the portfolio management side? How specific can a client get?
Not very specific. We are not targeting the hobby trading crowd. We're not targeting the people who who wants to deal with every single detail themselves. We're targeting rather the opposite.
Yeah.
So I would say the typical Robinhood customer is not our customer. We're not letting people do their own trading because we think other apps, other companies are doing that. There's nothing for us to add there.
Yep.
We want to offer something new here. So we have a few different portfolios. They adapt to your situation, to how much money you invest, how much money you have, to your background, your risk profile, these kind of things, of course. Then we manage it for you. And what we're doing here is, I think I mentioned early on, the concept of building blocks versus total solutions. Now, a trend following model or a momentum model or many other things like this, they are building blocks. I mean, nobody, not even a hardcore trend following guy will say to a client that you should put all your money in trend following. It's a great building block. You should have investments in that, but not all your money.
There's one person, Jerry, of course.
As I was saying that sentence, I'm thinking Jerry will disagree. Don't worry, I know Jerry is a great guy. I have nothing bad to say about Jerry. He's a great guy, but yes, he will disagree with that.
He wrote a very nice forward for your book, by the way.
yeah, definitely. No. I mean, I get his point of view, and put it this way: if I was at the moment running a large trend following hedge fund, I would probably say the same thing, and that's I get that. But if you have, I don't know, let's say you have $1 million investable money, would you put it in one single strategy? Because I wouldn't.
So just tell us the nature of this app. Then is it Hush.app? What's
it is GetHush.app. GetHush.app. At the moment, we are open for Americans. It's a highly regulated business, so we have to go jurisdiction by jurisdiction. At the moment, we're open for the US. But
US only.
Since you gave me the nice possibility to plug this thing, I better respond by telling you what's how we do things, because that's what your audience is interested in more than
for sure. Because that's exactly what I want to know then. So obviously, I was going to say it's a simple way for especially young people at $2.50, $5 a month to be able to be allocating capital. Andreas, what I'd love to know is how someone such as yourself, an established manager with the history, the track record, the experience that you have, comes up with a plan for what is the trading strategy for this kind of scenario where you're dealing with probably younger people. There's a lifetime ahead of them, long-term compounding, start that accumulation and compounding process early, probably not miss out on the big years, but you probably want to minimize drawdowns. You want to beat an index, presumably. So what was your thinking and how are you executing this? What are the strategies? What are the instruments?
I mean, the first thing is, for me, it's a very new target group. And that means very new considerations. If I manage a hedge fund, I can only sell that to qualified or accredited investors, depending on what jurisdiction you're in. But more or less, the rule for alternative stuff, like if I sell a hedge fund, first, I can't talk about it in public. I can sell it in public. I can get qualified investors in, which means that they need to sign a paper. They have a minimum of $2 million in liquid net worth, not counting real estate and so on. And therefore, they can afford the risk. So I have a very different conversation. They want risk. Now, if I build something for people who are just regular retail people, regular savers, some people, if wealthy people pay me to gamble with their money in a hopefully intelligent way, you got to do something very different here. We're dealing with a target audience that do not have that much money. They should not take the risk. I know people are selling them risk anyway, but this is the problem with the noise in the industry I'm telling you about, that there's always this get-rich-quick schemes and people claiming to do this and that with zero background or empirical evidence. So what I've done here is design something that fits the average person. It's a total solution rather than a building block that I was talking about. It's a total solution. So using the fractional share trading, we can allocate to many positions with a small account. We're building a systematic portfolio that's always long, always 100% long, allocated to stocks, bonds, and alternative investments, using various ETF vehicles, all selected to be low cost, highly liquid. We're allocating all over the world, exposure to every part of the world, every sector in the world. So we're talking about approximately 80 different positions at any given time. On a weekly basis, it's updated for momentum, for volatility, and for correlations. That means that we are shifting the risk on a weekly basis based on how volatility changes in the market, but also how momentum changes. So that means that if we have a strong stock market, this model will automatically push more of the money into stocks. It will never sell anything completely. We're always in the same about 80 different positions. Some of these are tiny. Some of them I don't expect to make money, which is something that a lot of people designing portfolios still struggle with. You can enhance the portfolio greatly by including things you don't expect to perform. Counterintuitive, isn't it?
Yeah, the uncorrelated properties of the things.
Exactly. Let's say you have a position, say maybe a long vola position, or you have some sort of position that most of the time slowly loses money. Over a 10-year period, you expect to lose money. The point in including a small allocation of that is that when the other things take a hit, suddenly you get a big spike in this. It's an insurance policy. It will dampen the blow when the blow comes, because the blow always comes. This is finance. Sooner or later, when you're not expecting it, something happens. It's like buying an insurance. Nobody says that I'm not going to buy house insurance because my house never burnt down so far. You pay a little bit of a premium, and it pays off when something happens. Of course, those things are tiny.
So you've packed in a Universa tail hedge protection mechanism into your fund.
Yes, absolutely. That's what it is. That's a small part, of course. Most of it is, depending on your risk profile, equities, bonds, and some alternatives.
And to be clear, Andreas, so ultimately it's all with ETFs. There's no individual stocks.
Yep, correct. We're doing all with ETFs. Makes much more sense for regular savers to do that. As long as you use efficient ETFs. The thing with ETFs are that there's a lot of great ETFs out there. And there's a lot of really dangerous or really stupid ETFs. The problem is there is no clear definition there are rules for how to set up ETFs, but those rules are a little bit too lax at times. Many ETFs are essentially very expensive structured products being packaged and sold to people who don't know what structured products are. Pretty big ethical issue there, but that's unfortunately. Never ever touch these things, and that includes the short bias ETFs, the leverage ETFs. Just don't touch them. If you don't understand that you're trading gamma, and from an option point of view, then you should not touch them.
Yeah, a large part of trading ETFs is just doing that due diligence on which ETFs you want to trade, because there is just so much out there, and you're not just dealing with a share in a company anymore. But are those ETFs all US listed, or do you actually choose from around the world?
We're dealing US dollar only at the moment. So US listed ETFs traded in the US. The ETF universe is very large at this point. And even 10 years ago, we would have struggled to build these this advanced portfolio with ETFs, now we can do it.
Don't
So we
forget
can
us
trade.
over here in Australia, Andreas. I know we're a small market, but one day GetHush over here.
There are US
Yeah.
listed ETFs for the Australian, ASX 200
Oh yeah, and we trade
share
it.
price index.
Well,
But yeah,
what I
yeah.
love about it is over here we've got the self-managed superannuation industry over here, and in the self-managed hands where it's up to individual trustees as opposed to funds managing it, an app like yours would be, wonderful. And there certainly is a lot of AUM in the self-managed superannuation industry here. So even though we're a small market, it's quite a big stake in dollar terms that could really get some use out of your app.
Okay, sure. Help
Yeah,
me set
well,
up the
that's-
local regulatory setup, and we're there.
Yeah, well, that's
Welcome
'cause,
to ASIC.
there's a
Yeah.
there's a
That's-
mandated 10, 12 more percent of everyone's income that must go into those superannuation accounts. So, it's been a destination point for managers for a while for that reason.
The regulatory side, by the way, if I can be the grumpy old man for a moment, is always a pet
Please.
peeve because,
Oh,
see, as somebody who's been in the business for a long time, regulations to me they're there for a reason. It's it's very expensive. It's very expensive and time consuming, and sometimes very limiting, especially when you deal with retail. There's a lot of regulation.
It
And then we
creates a
see-
massive barrier for entry, so it protects a lot of
Well,
big names in the industry,
should
and
be.
it gives a very big barrier for people
Yes.
like us coming in with these innovative products. It's a shame because it keeps the industry backward.
Yeah, but okay. So my biggest problem is, okay, you're right about that. It does cost a bit of money. You can't just, we're spending quite a lot on the whole legal and compliance structure and all of these things. What bothers me quite often is how often people get away with just not caring. There are people offering, we're spending significant money to make sure we follow all the rules, all the laws. And of course, in the internet space, you have a lot of people who just, hey, let's just do it. And they don't know that they're stepping into a legal minefield, and maybe they get away with it long enough to make a few bucks before they're shut down.
Yeah.
It's everywhere. It's everywhere.
You can't give this advice on financial services and products in Australia, but you certainly find on the web everyone giving advice, even though they know they can't.
Yep.
It's just, it's rife. And the regulators here, they've got the rulings, they've got the legislation, but they don't have the teeth or the support to regulate, if you know what I mean.
Yes, and after Internet 2.0 or the whole video influencer wave, suddenly everybody and his grandmother is an expert in everything, and people step into an arena that they don't know that they're breaking the law or don't care, and so we have to be very careful with a lot of things. I mean, you know how it works. There are all kinds of things you cannot. Yeah, there are all kinds of things you have to do, have to say, disclaimers, and what you can promise, what you can express. So sometimes you're competing with people who throw out the most absurd thing. Somebody throws out, I'm making this many percent a year. What are you making? Well, I can't answer that, can I? That's super regulated. I got to give you a whole big disclaimer first. I got to give you a bunch of paperwork to show that I've given you this information. It's much more complicated. When people throw out too much of these things, you should be very skeptic, because that probably means they didn't even care to get regulated or follow the regulations. That's okay. That's just my grumpy old man. Sorry about that.
No, we'll all be very grumpy about regulations. I think Europe, it sounds pretty bad. America is obviously a much better place to launch a finance business. Australia, I have some serious issues with the regulatory environment over here, and even to the point where my broker enforces rules that are above and beyond what the regulator requires. That drives me insane. So it's hard enough. So let's not moan about that too much, because we'll bore everyone. But can you give us any one last insight, perhaps, into this strategy for Hush, Andreas? And that is, if you're always in, what's the basic principle in that allocation process? In what sort of momentum or lack of momentum are you looking at to decide how to allocate?
Well, briefly, what I do is, first I have built an investment structure of a 6-level hierarchy. Imagine you have a top-level hierarchy of stocks, bonds, and alternatives. Then you subdivide each one into level 2, level 3, level 4, and so on. Like I divide maybe bonds into US bonds and non-US bonds, and divide from there. You divide into traditional equities and or equity-like insurance style products, or you divide traditional equities into developed and emerging. So I built this first
They're your
with
allocation pools.
Exactly. I see it as a sunburst chart. If you can imagine, you're starting from the center, you subdivide more and more as you move out until you hit the outer rim, which is the investable universe. First, I allocate target risk across there. Risk, mind you, not exposure, on a systematic basis. Based on that, I adjust that again on a weekly basis by recent volatility, using recent standard deviation of the returns. I adapt on long-term momentum. Long-term momentum, as we all know, has both empirical and academic confirmation for quite some time. It's not magical. Of course, nothing is magical. You don't want to pull the big lever all the way. I use it to tweak the positions. So you get slightly bigger, slightly smaller, depending on where the action is. You want to move to where things are, because usually in a bull market, things continue to go up. In a bear market, they continue to move down. So you want to scale with that. And of course, we take the dynamic correlations into effect as well. Nobody likes statistics. It's basically you're looking at covariance tables and these kind of things to build it. So that's done on a weekly basis to make sure we always stay in line. Of course, with threshold for when you trade, how far you allow the drift to go. But the point is that you should always have a rational portfolio adapted to current market situations. That's what I mean by total solution rather than a building block.
How quickly is this being monitored, Andreas? So is there a daily, weekly assessment? How frequently is it being updated, this correlation matrix and all of these different things?
Weekly. Because we have no trading cost, or rather we are absorbing the trading cost as a company rather than pushing it on the customers. So we have a fixed trading cost for the company towards the broker, and we're absorbing that as our cost, not theirs. So therefore, trading frequency, the only thing that matters is the tax optimization.
Okay. And you've got this tail risk protection in there. So if we do get a sharp shock, the tail risk protection kicks in. Is that via options, or how are you doing that to guarantee the tail risk protection?
Well, okay, guarantee is a super dangerous word in this business. But
sorry,
still,
rather than relying on correlation measures, is there any way you can?
Yeah. So what we do on that side, I mean, first is a balanced portfolio to begin with. So it's not as simplistic as a 60-40 model or something like that. Even though the principle behind such models, or the all-weather portfolio and these things, the principles are fine. We're doing something, I think, a little bit more clever, but it's the same principles. So we're including in this the alternative sector. In there, we have some hedge funds, as in some hedge fund type strategies are actually available as ETFs at the moment.
Yep.
Some of them are pretty bad or pretty expensive. A few of them are really pretty good. So we include those. We also include long volatility strategies, currency strategies, in form of ETFs. No options. No, I have long claimed that I used to be able to. I actually memorized the Latin term once for a conference just for the hell of it. My view on options is that I fear the Greeks even when they bring gifts. That's
no Trojan horses
like
here.
Yeah.
Okay, so I see. So you're investing in basically these uncorrelated ETFs that have demonstrated a track record, long vol or trend following, or
macros.
Short-term momentum, things like Alpha Quest, that type of short-term to capture the fast moves.
Mm-hmm. I know. Actually, I know the guy behind Alpha Quest quite well, but we didn't include it here. I think I was going to comment on the product. I have nothing bad to say about the product, but I am very regulated, so I shouldn't say what I like and not. But I have nothing against this product, absolutely not. So it didn't, in my view, it doesn't necessarily fit in this context, but I'm sure it fits well in other contexts.
Okay. Yep. All right. No, great.
Well, just on the ETFs, Andreas. So, how important is the liquidity? Like, do you, because obviously there are, once you get down to sort of 80 plus ETFs, I do know that the volume traded starts to dry up a fair bit. Can you trade a fairly low liquidity ETF without too much trouble, or do you have to have a fairly high bar for liquidity?
I don't foresee a problem in quite some time on that side. If you're managing a couple of billion, you have a different concern. We're not there yet. It's a very nice problem to have when you get there, I'll tell you that. But there are good problems and bad problems in this world.
Indeed.
Having liquidity constraints because you're managing too many billions of dollars is a very good problem. So at some point, things like that become a concern, but you have to be quite big for that. You got to take it into account, of course. You need to be careful with your execution. I mean, you can't just send a market order and hope for the best, but you should have some sort of execution algo to deal with these things.
Yeah, and also with ETFs, there are a number of ETFs that are newer, right? So it's not like you necessarily have a 20-year track record that you can throw in your back testing engine. Do you just take a logical approach to that, or how do you deal with that?
Yeah, I mean, there are different types of them, absolutely right. But ETFs still have rules. So you can check the rules. Some ETFs follow an index. Maybe the index has been around for a lot longer than the ETF. You take the index, you apply some reasonable cost estimations or assumptions in there and adapt that line, and now you have a pretty good proxy for what would have happened. That's one thing, if they track a certain index and the index was available. Otherwise, you look at the rules. What do they really do? And never trust the name of an ETF, by the way. The name doesn't necessarily correlate to what they do. There are some really horrible examples of that. So you can check that, and from there you can make a reasonable assumption about what the past would have been and how it would have worked. Sometimes it's easier than you think. If you look at the rules, you understand what the product is. You know what would have happened.
Yeah, fair enough. One technical question, answer it if you can, but it'll lead us into your newer book on Python and backtesting for yourself and all that kind of thing, building out the technology side of the business. Is there a significant technology build? I'm just curious to be able to manage these potentially, obviously, thousands, tens of thousands of Hush accounts. Do you get to trade this in a managed account basis where you put on a single trade and it's allocated to these many accounts instantaneously? And is that something that you guys have had to build out yourself, or you've been able to leverage the broker or third parties to help with that kind of thing?
We built a lot of things ourselves. So myself, I mean, I have some programming background, but I'm not a proper programmer, not a hardcore programmer. I've been programming since 1985. Scary thought, somewhere around there. And by the way, I think pirate copying computer games is beyond the statute of limitation these days, right? Hey, come on, I was 10 years old.
Exactly.
So anyway, I have some programming background, but not as deep with that. My co-founder definitely has, and we have very good programmers as well in the team. So we built most of this architecture ourselves. So we have the engine to calculate this, to manage the trades, to be able to execute rationally in each market. But it's not pooled. It's never pooled. Once you pool money, you end up in a very different, again, regulatory regime. You're a whole different bucket. I'm not saying it's better or worse, but it's very, very different. You can't mix the two. You can do both in the company, but there are two very different things to be doing. Pooled money.
Yeah, I understood it wasn't pooled. I just meant that you obviously press buy once, and it applies to all the accounts.
We don't press anything. There's nothing to press. This it's all automated. It's a completely serverless technology.
This is what you'd call an investor-directed portfolio service, IDPS, or whatever they call it, as opposed to a pooled fund.
Or
separately managed accounts, SMA.
They are separate managed accounts with a broker custodian, with broker dealer, with custody at the bank. So our model, our code will automatically on a weekly basis go over a bunch of factors, calculate a bunch of things, see if we need to adapt something, and do what needs to be done. But nobody sits down to look at a spreadsheet or press a button. Obviously, it's being monitored. Automated that never means There's a common expression in the business. Automated doesn't mean unsupervised.
Yeah. But it will collate orders together, mass orders from all of the individual investor decisions taken.
Yep.
Mass orders are executed via the brokers, all systemized and centralized. Yep.
Absolutely. And of course, in a different way, we're taking intraday liquidity into account, a bunch of other things to execute rationally, but automated. I mean, if you manage 10,000 accounts, you can't sit there and actually do the math by hand or on a spreadsheet and email orders in or enter the orders in the system. It works differently.
So when it gets so successful in say 1 or 2 years' time, let's give it a time. When you've got these multi-billion dollars, you're going to be moving the market with Hush.
That'd be a nice thought, but if you see how deep this market is, by the time we are big enough to move the market, I'm going to be sitting at the island that I just bought, having my drink, and I mean, seriously, in this market, is deep. We're not dealing with illiquid nonsense here. We're dealing with highly liquid stuff. Of course, at some point, I don't know. Look at poor David Harding. I feel sorry for him almost every day when I think about the 50 billion or something he's managing. It's of course once you're managing $50 billion, you have a liquidity issue. But what you can do, of course, which if I'm not mistaken, I think they did a bunch of years ago. They just lowered the volatility by half and half their fee structure. I believe, if I'm not mistaken. I have some memory of that anyway.
Okay.
So that's one way of doing it. Okay, fine. We're so big, we got to do things in half scale, but we'll be fair and charge you half the price. No, I mean, there are all kinds of solutions, but we're dealing with highly liquid ETFs, so I don't see a problem.
All right, Andreas, let's talk about technology a little more then. So you've written a book on it now. It's getting dramatically easier for people to program with Python to be able to build their own backtesting engine or other software related to trading in Python. Tell us about what you cover in the book and, the pros and cons of taking this path. How difficult is it? So on and so forth. What tools are out there, libraries and so on? How achievable is this?
Well, I mean, first I would say for anybody who wants to get into systematic trading, I mean, whether it's for yourself, as a hobby, as a business, whatever you want to do with it, you need to learn programming. It's not that difficult, people. Don't take the shortcut of some silly scripting thing or something very limited. Just learn to do it. It's not that difficult. You don't need to be an expert programmer, but I like to compare with, and I'm sorry, I said this so many times before when I get asked, but imagine a doctor or a lawyer like 50 years ago. You think they could type on a typewriter? No, that's a low-level job. They have a secretary to do that. Nowadays, imagine a doctor or a lawyer who can type his own things on a keyboard, who's like one finger at a time. Come on, he's a helpless baby. So things move, and at the moment, in this field, you need to understand this stuff. And it doesn't help to hire somebody to do it for you, because if you don't know exactly what it is, you're equally helpless. You just hire the secretary to type your letters. So learn that, but it's not that difficult. So what I go through is, first, that book was an interesting experience to me, because I wrote this for fun. I just thought it would be fun to write, to put down my thoughts and see what happens. I haven't checked the stats in a while, but it's probably my second best-selling book. It took off like crazy. I don't know what happened there. I thought, who's going to buy a programming book about quant trading with source code? Nobody wants that. It sold really well. So I tried to explain how to set up the environment, how to manage it, how to connect your data, and how to build and test your trading models.
How hard is it to build a backtesting engine?
I don't go into building a backtesting engine. I go into setting one up. You could build your own, slightly more advanced level, but in the book, what I say is there are open source alternatives that you can install yourself. You can hook up your data to that, and if you understand some Python, you can very easily figure out what parts you like, what parts you don't like. You can check how they do their math. It's all open source. It's not like Microsoft Excel. You can't check the details on how they do the math. You just have to trust them. Python is open. So what I use in the book is something called Zipline. Zipline was originally built by a company called Quantopian that I was very close to back in the days before they went under. I was a frequent speaker at their events in New York and Singapore. They unfortunately went under, and a lot of people thought that's it for their platform. They built this great backtesting platform called Zipline. The opposite thing happened. It's open source, right? So open source community took it over, and it's actually been developing better and faster after that. Particularly, there's a few different forks taken over by different people. There's one I use in the book called Zipline Reloaded. It's an excellent platform, and I would say that's a great starting point for anybody. It's completely free, by the way. You just start with it. You need to figure out your own data because it doesn't come with data, but the platform is totally free.
Does that include, all the nuanced parts of backtesting? Like the ability to deal with adjusted prices on stocks and
absolutely,
all the
better
little things that.
I'll tell you an impressive thing that Zipline does that I haven't seen any other reasonably good open source library do in a way. On the futures side, you don't feed it a continuation. Like a lot of these platforms, they work with continuations, which again was a good enough solution back in the days when we lacked computing power. But why would you want to backtest on a continuation? Because that's not really what you're trading. So what I do in Zipline is, I feed it like 25 to 30,000 individual futures accounts, futures contracts, individual contracts with a start and an end, and the data between there. And the backtesting engine itself can from there, depending on my parameters, calculate continuations when I need it based on that. But we're not trading the continuation. We are trading the actual contract, like in real life. That also means I can do a lot of more complex things. I can do spreads. I can do curve strategies. I can trade further out on the curve. As Rich would definitely know, I mean, most of the time in futures world, you trade the front contract, but there's lots of interesting strategies where you trade something else and you ride the curve itself and trade the term structure.
Yeah, in your book, you include a very good section on trading the term structure as an additional source of revenue to the trend following method. But it was excellent there. But that's interesting. So you've got all of your contracts in place. So obviously your backtesting is also telling you when you need to roll. So you're getting all of that information coming out of it as well. That's great.
Well, I mean, it's not really telling me when to roll. I can get the information to decide myself, which is what I do.
Yeah.
I mean, with a continuation, it's somebody did it for you, and now you need to understand exactly what it does and how this flawed estimation of reality impacts your results. If you trade the individual contracts, I can have my own logic for when I want to roll.
Yeah. Oh, that's great.
Okay. I think we should start to wrap it up. We've been talking for almost an hour and a half.
Sure.
Rich,
the
if
worst
you don't
thing
have
about
anything
it is
specific,
we could go on for hours with Andreas.
We could.
But we do have to wrap it up.
Maybe he'll let us.
Always happy to do another session, guys. Just let me know.
Get him on the show for a part 2. That would really be cool, actually. And I guess just to finish off, Andreas, do you want to just talk about your websites, people getting in contact with you? I mean, I know that the trend following site's been around for a long time, but you've got a few contact points now. I'm not sure exactly what's the most relevant to you and what people should be looking at. But
true, I've been doing a lot of things. I used to say that I always struggle to explain to everybody, including people in the business, what I do for a living, because I have a short attention span and I do a lot of different things at the same time.
The many hats of Andreas Clenow.
Yes, and I need them as well these days. So I would say if you want to get in contact with me, the easiest thing, and that is probably the easiest one to remember as well, clenow.com, and you'll always find me there. There's not too much there. It's just a personal website trying to collect a bit of things that I do. Haven't been updated in ages, but at least you can always get in touch with me on there. I'm a pretty easy guy to get hold of. I have run since quite a while an automated analytics website called clenowresearch.com. That was actually that was my therapy project when the world shut down, as you might remember, some 4 years ago or so. When there was a few weeks there where you could really do nothing. Everything was down, and you don't know if you just took massive losses or not. Or there was a scary few weeks there, and we all needed some therapy projects. So I built an analytics website, and I taught myself how to build a Python-based analytics website.
So behind that paywall, Andreas, there's a lot there. Obviously, I was almost pressing the login button and the subscribe button, but I was holding myself back. But there's a lot of content behind that paywall.
Yep. Yeah, it's quite a lot of analytics on stocks, futures, and ETFs, including automated trading models with the updated results every day, the analytics, the rules, all of this stuff. It's all on there, and it's a completely automated website. So that was my therapy project when we all needed therapy for a few weeks back then.
Well done. So,
I run that one, and of course the GetHush app, where we are trying to launch our venture, and that's pretty much it. But you can always get a hold of me on LinkedIn or anything else as well.
With your Hush project. That's so
Are you
exciting.
A little more active on Twitter these days, or not really? You're not really.
I'm starting to. So I usually get active on social media when I have something that was just released. That means most of the time I don't participate that much in discussions on social media. But when you have a book or something coming out, in this case the app, you get a little bit more active, start talking to people, and it's usually a lot of fun things come out of it. In between, I tend to be a little bit too busy, but I'm getting active again, so I'm on Twitter and most of these things as well.
Great.
Yeah, cool. All right, Andreas. Well, we could definitely do a part 2. There's always so much to talk about. We could deep dive a particular topic of interest. We'd love to follow along with Hush as well. I think that's a really interesting project. We should bring that out to Australia. Those kind of things are popular here. They do well here. So. We wish you really well with it, and with the novel, A Most Private Bank, which I'm looking forward to having a read of.
I can't wait.
Yep.
There we go.
Oh, yes.
And I'm looking forward to the movie.
Yeah, that'd be nice. That'd be nice, yes.
Indeed. Well, that'll be a shift away that'll definitely be another hat you'll be wearing. All right, we really need to wrap it up. So I'll just say thanks once again. It was a real pleasure, and we look forward to keeping in touch.
Thanks, guys. It was fun.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives. So nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky, and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.